Well, good afternoon. My name's Mike Wilson at Flaxman's, and I'm leading this webinar this afternoon with Roger Flaxman, and it's on the subject of the Financial Services Compensation Scheme. Unfortunately, for technical reasons, you can't see Roger, but he's still going to co-present this webinar with me. And I now ask Roger to bring us his introduction.
Good afternoon. The topic of this webinar arose from a client of ours that had been overpromised by the insurance industry. The client was the insurer actually of a well-known broking house, and the client had specifically asked for confirmation of the security of the insurer that the broker was recommending. The insured had once before been the victim of a collapsed insurance company and didn't want to go through that again. The broker said, and I quote, "There's nothing to worry about. There is a government insurance scheme to protect policyholders for 100% of their loss," unquote. They proceeded to place the insurance with unregulated security, and I need to tell you what happened next. So that caused Mike and I to gently ask the brokers and other insurance people we come across every day what they knew about the rules concerning policyholder compensation. And pretty much without exception, there was a pregnant pause when we asked the question, and the answer was clearly, no, not really, I don't know. So, we also learned from the general discussions we had with these people that there's not very much awareness of just how many insurance companies have collapsed over the years, and there have been a good few. So we thought it would be a good idea to raise the awareness a bit, and also to link this topic to any other questions you've got this afternoon about giving client advice and giving reassurance so that you can contribute positively to regaining the trust of the public in our insurance community, because that's really what we're trying to do. So before I hand over to Mike, just let me tell you a little bit about what we do, in case any of you are completely new to our webinars. Flaxman's, I think, I fair to say, unique in the insurance industry in that we are claims advocates, and what we do is we try to resolve disputed insurance claims without going anywhere near litigation. Basically, what we're doing is to say, let's look at this as real professionals. We understand insurance, we know how it's practiced, and when the misunderstandings occur between insurer and policyholder, and they are often misunderstandings, then we, as a group of us, and we go in and we'll say, let's have another look at this, let's look at it a different way, and see if we can close the gap. Now, in the course of doing that, we come across just about every class of insurance you can think of, and most of it's in the UK, and we resolve about 90% of those cases quite successfully. So what we see in those cases is quite interesting, because we see a lot of written material, we see a lot of correspondence from insurers, we see correspondence from brokers, and in addition, we see witness statements, because from time to time, we act as an expert to the courts. And in those cases, we see the real down and dirty stuff as to who said what to who, when and why, or didn't say. And so we've got a very interesting balance of knowledge of what goes on in the background, if you like, in insurance negotiations and transactions. And what it enables us to do is to see, if you like, the holes in the industry's conduct, I think is the best way to say it. People are often saying, oh, well, we've got to become more professional. We want to be a professional rather than an industry. I think we all agree with that. And we will later on this afternoon, if we have time, talk a bit about what professional looks like when you're sitting where we are, which is looking at something after the event. So, Mike, over to you.
Well, thank you, Roger. Thank you. I better just read through the learning objectives of the webinar. So it is, what is the Financial Services Compensation Scheme? Which policyholders are eligible? And to know the limitations for consumers, business policyholders, and geographical location. Understand to which classes of insurance the Financial Services Compensation Scheme applies. To know the monetary limits to the scheme, and to gain sufficient knowledge to prevent policyholders from being given blanket assurances that might be misplaced. So first of all, just a few brief words about the origins of the FSCS. It was established under the Financial Services and Markets Act 2000 in December 2001. And if you've been around the business for long enough, you might remember that this replaced the Deposit Protection Scheme, the Investors Compensation Scheme, and then what used to be known as the Policyholders Protection Scheme. So, which policyholders qualify? Well, the focus has always been on consumers, and this is something that is not always readily understood or appreciated. So the protection for businesses is very restricted, extremely restricted, in fact, and it applies only to small business where the turnover is less than £1 million. That's quite low these days. And in fact, that figure has not changed since the scheme was introduced in 2001. And another common mistake is for people to assume that the turnover qualification threshold will have changed in line with the threshold that applies for access to the Financial Ombudsman Scheme. But that's not so. So you may know that a business can go to the Financial Ombudsman Scheme or Financial Ombudsman Service if the turnover is under 6.5 million, and one or two other criteria. But for the FSCS, it's only businesses up to 1 million turnover. However, the restriction on business protection does not apply to compulsory insurance. But generally speaking, if you're advising people as to their access to protection under this scheme, you need to bear in mind the £1 million figure. In fact, the previous schemes that applied before this, that was on the previous slide, prior to 2001, there was no protection for business at all. So it's very minimal. Roger, this slide here, which policyholders qualify? Should we just have a discussion about these headings here, starting with the commercial insurance policy?
Yeah, let's start with commercial, yeah.
So, Roger, would you say that we could make a blanket assumption that commercial insurance policies are protected?
Well, no, I think we can't, because we know from experience that we can't. I think the criteria that is used for what they consider a small business, it has to be under £1 million of turnover. But in practice, you sometimes find that the smaller businesses have got some link to some other business. They may be part of a chain or part of a group, and there are all kinds of franchise or something like that, and there are all kinds of mischievous little things that can get in the way. Fundamentally, though, if you think of it like this, if a business is small enough, but really it's just kind of a one-man or two-man business, and is very, very clearly, a turnover of less than £1 million, then that's really what this scheme is focusing on. Anything which is more of an established business, you can't really expect for it to be included. So it is well worth boning up on these things before you start advising clients, because as we found from our little bit of research, there is virtually no knowledge of it whatsoever amongst the industry. The micro business, what's the difference between a commercial insurance policy and a micro business? Well, it's the size. A micro business is probably, what do you say, Mike? Well, it's my bam, isn't it?
Well, I think in the context of this webinar, we need to take a micro business as being a business with a turnover under $1 million.
Yeah.
Whereas SMEs in this context would be although they're still classed as small, an SME these days with a turnover over $1 million just won't qualify.
No,
but
exactly.
What about charities and other not-for-profit organisations? Do you think they're treated as a business?
Well, I think the point is some and some, because some charities pretty much are a business. I mean, it is a form of business, and again, I think it's simply going to come down to the size and the scope.
So I think the safest thing. So I think the safest thing to assume would be that for a charity that they would be caught by the same £1 million limit.
Yeah, absolutely. I think that's exactly right. That's exactly the way to look at it. Similarly with partnerships and LLPs. You know, if it's anything more than £1 million, assume that it won't qualify.
Yeah. Okay. Well, that's helpful. Thank you for that, Roger. So there are some limits you need to be aware of, and we've split them into 3 columns. I'm sorry if it's a little bit small for you to read, but we thought it would be helpful to have this all on the one slide, and we don't expect you to take all these details in at one go, and we are going to make some information available to you after this webinar. But just to get the principle understood, so in the first column, these are the policies that will qualify for 100% protection. So just going down them briefly, there's third-party motor, employer's liability, income protection insurance, professional indemnity, death or disablement under a PA policy, and also building guarantee policies for firms that failed on or after the 8th of October 2020. So that's quite a restricted list. I should just add that because Roger and I don't specialise in life and pensions work, we haven't included this on this slide, but as a general rule, what's known as long-term insurance, which would be most life and pensions business, will qualify for 100% protection. But if you're involved in that side of the business and you want to be able to give an accurate answer on that, feel free to contact us afterwards. So the second column lists those policies where there's a 90% protection, so that's motor first party, pet insurance, travel, home, dental, health, warranty, public liability, and property insurances. Which leaves us with the third column, which is a bit of a puzzle, I have to admit. It says these are policies which are excluded altogether. So that's goods in transit, marine, aviation, credit insurance, and then contracts of reinsurance for insurance firms or brokers or financial advisors. The reason I call that a puzzle is that I don't understand it. But before we discuss that a little bit further, Roger, what we haven't mentioned here is Lloyd's of London. What's the position with Lloyd's policies?
Well, they're not subject to the same scheme. And Lloyd's has got its own capital structures, which actually are quite complicated. And what I'm going to advise, I'm going to speak a little bit about it, but if you want to understand Lloyd's and its security system, the best thing to do actually is to go onto the Lloyd's website, because it's nearly all there. But it's not entirely consumer friendly, some of this. But fundamentally, you've got in Lloyd's three areas of protection. The first one is the working capital of the syndicates. And what happens there is all the premiums received by the syndicates are held in trust. And it's the first source for paying out policyholders' claims, etc. Yeah? And interestingly, Lloyd's, until all liabilities on a year of account have been provided for, no profits can be released. Therefore, every syndicate, they have to reserve for future liabilities each year, which is a different method used by other insurance companies. Now, the second thing is the funds at Lloyd's is members' capital deposited. So each member, whether corporate or individual, they've got to put sufficient capital to support their underwriting at Lloyd's. And this determines to a large extent how much they can underwrite and what the solvency margin is going to be. Then the third one is the central assets, or the central funds, as it's sometimes called. This is central funds which are held by Lloyd's as a last resort. And I think the last time I saw these, it was in the region of £55 billion. It might have gone up a bit more since then. But fundamentally, Lloyd's runs its own show, as most of you will know. And personally, I haven't had to come across, not for the last 20 years, a policy where security has been even vaguely a question. Most of the things that we see are from unregulated insurers. But going back to the slide, goods in transit, marine and aviation, as you know, are very much maritime and Lloyd's types of contract, as is reinsurance. And we haven't been able to find anybody yet, even at the FSCS, that knows why they were excluded. So if anybody out there does know exactly why they weren't included right back in 2000, it would be interesting for us to know as well. So does that cover that for you, Mike?
Yeah, no, thank you very much for that, Roger. It still leaves us a bit of a mystery, but maybe somebody can let us in on the secret. But it just underlines the need to be very cautious as to what undertakings you give to policyholders, because very easily we could give people the wrong answers and in the process give them some false assurance.
Well, it would be wrong even to say that all policies at Lloyd's are 100% guaranteed by a government fund or anything else. It's just not the right thing to say.
No. Well, thank you for that, Roger. There's a slide here I've just put here about claims for unexpired premium. For most policyholders, that might not be of any great concern, but if your insurer becomes insolvent and you've only just paid a premium and you've got to fund a replacement policy, it won't go down too well if you can't claim a refund of your premium. And the answer to whether or not you qualify is dependent on what the policy actually says about entitlement to premium refunds. There are some policies which will not allow for any refund of premium, in which case you're not likely to get a refund through the Financial Services Compensation Scheme. This became quite a big issue a few years ago when a lot of solicitors firms were placing their professional indemnity insurance through unrated insurers. And clearly they wanted to know to what extent they were taking a risk in paying a premium. So, for instance, you might have had a sole practitioner whose premium might have been as much as £20,000, and he was concerned that if he paid that premium and then the insurer became insolvent, would he have to start again with a new insurer without his return of premium? And it's a difficult issue because most, if not all, solicitors' professional indemnity policies don't have a provision for the return of premium. So again, it's another issue that's not always as straightforward as you would think. Territorial limits. The FSCS applies to the United Kingdom. People often get confused as to what United Kingdom means. So just to remind you that it includes Northern Ireland, but it excludes the Channel Islands and the Isle of Man. If you are looking at a policy that's been issued by a European insurer, then you just need to check the policy because it's become a little bit complicated since the UK left the European Union, and the only way to be absolutely sure whether or not the FSCS applies is, first of all, see what the policy says, and secondly, just in case the policy was written before Brexit, speak to the insurer and ask them. We're going to cover a number of different issues here, but this is all under the heading of make no blanket assurances. If in doubt, ask. And we're also going to cover the issue of checking on insurers' rating and solvency generally. Now, Roger and I are just going to make a few observations, but we're conscious of the fact that some of today's delegates will be brokers, and some will be some of the delegates will be working for insurers, and it would be possible to make the mistake of thinking that this is a problem only for brokers. But we need to bear in mind that policyholders are a little bit jittery these days. They've read all about the financial pressures being brought to bear on general insurers, particularly with regard to the business interruption claims connected to COVID. And there are more policyholders out there asking now, what about the safety of my insurance company? And it may well be that they'll ask that question, yes, to the broker, but if it's a direct relationship between the policyholder and the insurer, then the insurer also needs to be ready with the answer. It would be no use at all to say to the policyholder, oh, well, we're the biggest insurance company in the country, and that would never happen, because you have to assume that it might. So, Roger, perhaps looking mainly from the broker's point of view, what are the requirements placed on a broker through ICOBs, for instance, in terms of advising their policyholders as to the security of the insurer? And of course, how can the broker be sure that when selling a policy, it's a policy that, when it comes to crunch, is actually going to work?
Well, if you take the second question first, I think the answer is you can't. One of the lessons, I suppose, that's been learned from the COVID issue on business interruption and indeed on travel insurance, there have been hundreds, if not thousands, of policyholders who said, well, I read my policy and it seemed to say this, and you seem to say it didn't mean that. So when it comes down to that aspect of coverage of security, I think we've got a really big problem to deal with, because we've even got insurers who've got wordings which are almost identical, particularly in the business interruption, well, actually, and in the travel section. We've done quite a lot of travel stuff recently, where the words are very, very similar, for particularly things like cancellation and curtailment. But different insurers and different loss adjusters simply interpret them differently. Now, that doesn't do the industry any good. None of this, of course, is to do with the security ratings or categorization as such. It's really to do with the real issues of what the industry is selling to its customers. Now, as you know, because I said this right at the beginning, one of the things we do quite a lot of is give expert evidence to the courts on these types of issues. And one of the things I think might be very helpful for everyone to just have a refresher about is what ICOBs, which Mike mentioned a moment ago, really means. Because we would say, from experience, that most people in the industry couldn't write one page of A4 of what ICOBs is all about. They know its regulations and they know where to look them up. But there is a big gap between ICOBs being a regulation with a purpose and actually ICOBs being carried out in practice. And what I'd like to say is this, that ICOBs are not difficult to understand if you start from the very simple principle that they are there as the embodiment of ordinary good practice. There's nothing extraordinary about ICOBs that you wouldn't do if you were, if you like, doing the job properly. Now, the first thing about ICOBs is that if you step back from the regulations for a moment, you can say that an insurance broker has a common law duty to exercise reasonable care and skill in performance of his duty. The common law is over and above ICOBs. What happens with ICOBs, apart from where the FCA may want to take a regulatory breach for the purposes of punishing the organisation, ICOBs come into virtually every dispute that goes into litigation. The first thing the lawyers do is to go through and look at all the things that have happened between the insurer, the underwriting agent and the intermediary and say, right, which of these ICOBs can we tick off as in breach? That's how it works in practice. The second aspect, of course, of, if you like, good practice, is what the contract between the parties say. Now, we're talking here largely of contracts between brokers and the customer, but there are also an increasing number of disputes arising between the insurer and the underwriting agent stroke intermediary, particularly where the broker has some kind of authority. So once again, that goes back into the FCA regulations, and we start looking at ICOBs and we start looking at trends. And those things come very much into focus. The third thing is, of course, the regulations themselves. And this is where you've got the handbook, the source book. And the obligation has got to be for the parties to merge those things together so that they're seamless. Now, coming back to the point about security, because that's where we started this afternoon, it's almost impossible for anybody in business to foretell which company is going to go bust. I was around at the time, I've got what year it was now, still broking at the time that the Independent went. Now,
I think that was 2001, Roger.
I think it was, yes, exactly. I think it was. And that company has many years been everybody's best friend. And nobody really foresaw what was going to happen or why. We've had company, you'll come back to this later, Mike, I know you're going to talk about this. The company after company have failed over the years, mostly in the smaller and overseas type companies that have said, well, we're going to set up something medical and independent and we're going to beat the market. What is the responsibility of the insurance industry when they're talking to customers about these things? Be very, very, very careful that you don't overpromise that these people are sound just because they are authorized and regulated. Because representations like that can be actionable by somebody who's relied upon it. We have a client at the moment who is going to take action against some parties, and I won't obviously name anything about who they might be, but quite wide and broad declarations of this will be absolutely fine. This is dead safe security. There's not very much else one can say about security in that context, except that when it comes, as I say, it comes back to what are we actually doing? We're simply saying, here is the rating agency's rating, and there's nothing much more you can say about that because the rating speaks for itself. If you're going to talk about a specific company and they haven't got a rating, the mere fact they don't have a rating doesn't mean they're insecure, but it's the kind of thing that you ought to go and have a chat with Litmus about and say, well, actually, what does this mean and what can I reasonably say? Because the most important thing is that the customer is reassured by the real facts. And
Roger,
most of us in the industry on a day-to-day basis don't have more facts than is available from the agencies.
Yeah. Roger, I'm just conscious that some people won't know anything about Litmus. Could you expand on that?
Litmus is the trading name of a company that is, its sole raison d'etre is reporting on, managing, and giving information to our industry on rating agencies, credit agencies, how they work, what they mean.
And do they have a connection with BIBA for those brokers?
Yes, they do. Yes, BIBA. It's a BIBA. It's a BIBA scheme. Yes, they do. And I've known these people for many years, and I take my hat off to them. I think it's an absolutely tremendous service. It's really useful. If you want to know anything about security, then they're the people to talk to.
Right. Well, thank you for that, Roger. Folk today might be forgiven for thinking that insolvencies don't happen that often, but we got in touch with the Financial Services Compensation Scheme this week, and I'm just going to run down the amounts of money that have been paid out since 2016, and you can see the trend. So in 2016, they paid out 271 million. In 2017, it was 351 million. In 2018, it was 405 million. 2019, 473 million. 2020, it was 527 million. And this year, it is 584 million. Those numbers are staggering. However, that's not just insurance, you'd be glad to know, because that covers the whole scheme. But just to give it a little bit of context, the current provision for insurance insolvencies in the current year is something like 175 million. And also, some of you who are more involved in the life and pensions side of the business ought to know that life distribution and intermediary work on the life and pension side for the current year is likely to be as much as 323 million. So these figures are astronomical. And of course, they've all got to be paid for through the levy and through the premiums that you and I pay. I've also looked at the list. At the moment, there are 39 insurance company insolvencies, which the Financial Services Compensation Scheme is still dealing with. I'll just run down the list. I've not put it on the slide just in case any of these names get confused with more solvent companies, but AA Mutual International, Alpha, Anglo-American, Builders Accident, Bermuda Fire and Marine, Black Sea and Baltic, Drake, Enterprise, Eric, otherwise known as the European Risk Insurance Company, Gable, Horizon Insurance, Independent that Roger mentioned, that's still, the tail end of that still being resolved, Lemma Europe, Aldgate Insurance, Exchange Insurance, and that's not the full list. So these things do happen, and we need to be aware that we can't assume that any particular company is beyond going into financial trouble. I'm going to invite questions, although I've got a couple of other issues that we can discuss. But if you've got any questions to raise or points to make, please write them in on the chat facility. Quite a lot of claims, in fact, the majority of claims under the scheme for insurance policies relate to claims. But of course, quite a lot of the claims which are the subject of the claim against the scheme will be disputed claims. So if you're guiding people on the procedure here, if there's a disputed claim, bear in mind that because of the fact that this is primarily aimed at consumers and very small business, most, if not all, of those disputed claims are eligible for the Financial Ombudsman Service. So the Financial Services Compensation Scheme will expect that that process has been resolved before the FSCS is involved. There's no point presenting a complaint about a declined claim to them if you haven't already gone through the Ombudsman. Roger, have you come across any situations where you know that people have made blanket assurances about the scope of the FSCS? And if so, are you aware that this is an issue that's not only misunderstood by brokers, but also maybe by the insurance companies themselves?
I've certainly come across quite a few, and funnily enough, quite a lot of them are in the construction-related industry, in the building industry. And I don't know why that is, but it's just the way it turns out. I think that it's very easy when people are selling to say, yes, that'll be fine. Oh, that will never happen. That's the kind of thing. And these are the things that, as I said, I often read in witness statements. Brokers said, oh, I never said that. Or, I never said so and so. Well, the client has written something else down. So they gave me a guaranteed assurance that this company was safe and secure. Now, this is sort of hearsay stuff in a way. But the point that we've got to make is this, that most of the time we're in an industry which is fearfully competitive, and most of the time, shall we say, the authorities have been perfectly happy for new people to come in into the market, try the market out, see how it goes, and some of them fail and some of them don't. Now, that is a status quo we're not going to change. The question is, if a customer is particularly asking about the security, what you can't simply do is say, oh, that'll be all right, there's a protection scheme. It's not as simple as that. And I don't think we can say much more, Mike, other than just be very, very careful what you do say, because it can come back on you. And in some of the litigation that we're seeing, particularly the broker and sometimes the underwriting agent is getting it in the neck for just being rather sort of loose about the expectations that they were causing the customer to accept.
Well, Roger, can I ask you, therefore, for your opinion on the way that a typical insurance policy is worded when it comes to the financial services compensation scheme? So what I've got in mind is I've seen some policies that says XYZ Insurance is a member of the financial services compensation scheme, as if it's some sort of voluntary association. And there's rarely anything in the policy itself that draws people's attention to the scheme's limitations. Do you think there's more that either the industry as a whole could do to alert people to the limitations? Do you think there should be something in the policy, or do you think there's a need for an extra sheet in the paper, or maybe an extra sheet issued by the broker to explain these things? What do you have a view on that? How far do we go?
My first view is I think anything to do with extra sheets of anything should be a no-no, because there's too much already. And frankly, we know very well most people don't read it. Whether they should or not is another matter, but most people don't read that kind of thing. I think the point is, I had it pointed out to me by counsel about a year or so ago, on one of the comments you just made, what's in the policy. And he said, well, of course, this gives the customer the expectation that they will get compensation. And actually, that's right. That's the reason it's there in the first place. The question is, how much more do we need to do as an industry to lead or to protect the customer? And it's a golden question. I'm not convinced that there's very much more that one could reasonably do. But the figures speak for themselves, Mike, don't they? They're ginormous figures. Things are going wrong. And it's a subject that virtually nobody knows about. So the only purpose of bringing this up today is that actually I think it should be on the agenda, because security of insurer and security of getting their claim paid is what insurance is all about. And we've never been in the spotlight so much as we are now.
Right. I've got some questions up here, Roger. Perhaps if you could have a go at them first. Suna asks, are goods in transit, marine, reinsurance, etc. excluded because of the international exposure?
Well, I think that's probably very likely, but the truth is, I'm be honest with you, I don't know, and I haven't found anybody that has given me a good answer. We've asked around for the last couple of months before we did this, and people say, oh, don't know really, but I think that's probably as good a reason as any, that it is international. Yeah, I think you're probably right.
Peter says, does the 100% protection, so there was the three columns, so in the first column, does the 100% protection apply to companies with turnover over $1 million? That's a very good question. Just looking at that list, I would say that in most cases that would be the case, because these are primarily compulsory insurances, such as third-party motor and employer's liability. But it's always good to check that out.
I think the answer is, I tend to agree with you. Yes, I tend to agree with that. Yeah. But I mean, if asked the question, we would have to check that out as well, because I'm not 100% certain. I think you're right.
Well, thanks for that. Yeah. So Suna says Lloyd's capacity rules have become incredibly strict and robust. That's why you don't see any individual new names, only corporate names. Is that something you're aware of, Roger?
Yeah, absolutely. Yes. Yeah, absolutely. I've just seen a question. This has just popped up. Let's see what this one says. How much time do customers give us to help them understand what is an extremely complicated subject? Very little. But I have to say that that is not an excuse for not doing it. And I'm not saying that. That's not me, it's not my judgment. But the judgment in law would be the fact that you haven't got much time to do it or opportunity doesn't take away the responsibility for doing it. And that, comes back to the subject of how we manage our business in the future. I would say probably 60% of the things that we see now that have gone wrong somewhere are as a result of digitalization, taking our industry's people's mind off the job, because the process has overtaken the delivery function. And I'm looking at a case at this very moment where a company of some reasonable size, with 5-6 million turnover, has found themselves very substantially underinsured. And they've been underinsured for several years. They've had a very serious claim. And all the evidence is that the insured failed most years to engage with the broker in the renewal process. They just didn't show very much interest. And I'll tell you that counsel's opinion on this case at the moment is that the broker failed to do enough to say to the client, you're not engaging, we can't help you. That is what counsel are saying. The broker didn't do enough to say, look, you need to pay attention to these things, because if you don't, our advice can't be sound and certain. So that's not something people want to hear. What people want to hear is if the broker, this applies to insurers as well, on direct case, but if the insured doesn't want to give you much time, you've still got to overcome the hurdle of the obligations that are put into the ICOPs, which are basically saying, if people come to you, they're coming to you to do something that they can't do for themselves. And I think that we need a wholesale review in the not too distant future of how we replace, if you like, or replenish that level of advisory service, if you like, to customers, where the digitalization has actually removed quite a lot of the opportunity to give it. Because if actually the process is so quick you don't need to speak to anybody, then you won't get the opportunity to say so, and you won't get the opportunity to hear what the client says. This is a frightfully complicated issue, Mike, and it's not going to be solved in an afternoon.
Right.
I also see
Incidentally,
somebody...
Sorry, you carry on, Roger.
Matt Bramley has says he disagrees about Indy. It was clear from about 6 months out that there was something wrong. I kept a scrapbook of press clippings well before and warned both clients I had with them that it was not looking good and to be ready to jump. Well, Matt, you and I don't know each other, or at least I don't know you, but I can say the same thing because I could see it coming, but the industry didn't or chose not to. And we know what carnage ensued. The point is that the majority of people in the insurance industry know that customers buy insurance largely on price. And Indy was all about price. When I started in the industry in 1970, one of the first things that I was taught, in those days we were broking face-to-face in Lloyd's, was if there's a long queue at a syndicate, don't join it because it won't be there next year. And that was just one of the things that was said. Because when people queue up to go to a place because it's cheap, it doesn't matter what you're buying, cheap is there for a reason. Inexpensive, if you want to call it, is there for a reason. So I think that it's absolutely fair to say that if you took the view that this is too good to be true, then I think people, and some people I know did say, well, yeah, there's something wrong with Indy. But there's other companies, I'm not going to name them, but I can think of other companies that for about 20, 25 years have been extremely cheap. But they're still in business. And that's why I say sometimes it's just too difficult to know.
Yeah. Roger, can you see the comment there made by Victoria about the Zurich wording? I could read it if not.
Victoria, yes, here we are. Victoria, yes, Victoria, yes. Is this okay? This is a Zurich wording. Let's have a look. The Financial Services Compensation Scheme, we are covered by a financial supplement, which means that you may be entitled to compensation if we are unable to meet our obligations to you. Yeah, I think that's actually quite fair. I think that's quite good, actually.
And then it also gives the link to the Financial Services Compensation website. So that's one of the better wordings that I've seen.
Good, yeah.
I do wonder...
It doesn't create a false impression.
No, I think that's one of the better ones, rather than some of these ones that says we're members of the FSCS, which is pretty meaningless. I do wonder, however, whether an extra sentence to the effect that protection for businesses is very limited, or some sort of warning, wouldn't be misplaced. But that's obviously something for each insurer to consider.
Well, I think there's got to be a draw of balance, because let's be honest about this. Insurance is a product that is being sold. And when you're selling something, you don't want to derogate it at the first point of contact. You don't want to say, I want to sell you this, but actually it might not be very good. And the problem that we've got in our industry is that there are aspects of insurance that might not be very good. Of course, the public know it and are looking for opportunities. So what we're saying is, whatever you do, don't go and give a guarantee. Don't overpromise. Don't over-reassure. But the more that we can do to point people to understand what they're buying and what the pros and cons of it are, the better. But that comes down to how you're going to deliver professionalism and deliver, if you like, the service of an intermediary that the customer can't get or can't do for themselves. That's the bit that we've got to focus on. How we're going to deliver that in an age of faster and faster digitalization.
Well, thank you, Roger. I think we'd better leave it at that. I think our time is coming to a close. Please do get in touch with us. In fact, we have written a fact sheet all about the Financial Services Compensation Scheme. So if you would like a copy of that, or indeed a copy of these slides just as an aid memoir, the easiest thing to do is to use the email inquiries address there. Just send us a short email and we'll be happy to follow up with some additional information. And with that, I'd like to say thanks very much for sitting in. I hope you think it's been worthwhile. It's a complicated subject. Part of the aim of today was to just highlight how complicated it is. And if we've encouraged people to be a little bit more cautious about the reassurances that are made, then we'll feel it's been worthwhile. So thanks from me and from Roger.
Yeah, I'm sorry about the technology today, but Michael and I are both overseas because we're on holiday, and this event was planned, I think, after we'd made our holiday arrangements. So anyway, I echo Mike's sentiments. This is a hugely complicated subject, and if we can just raise the awareness of it, and anybody out there that's inclined to do so, to take it up within the insurance companies and within BIBA and within the CII, then I think it would be doing everyone a favour. Okay? Thank you very much, and goodbye.
Thanks, everyone. Bye now.